In this video, we master 4 rank to contextualize market volatility. We have established that implied volatility represents the market's expectation of future movement, but a raw 4 number is often meaningless without context. And 4 of 30% might represent panic in a stable utility stock, yet signal a quiet day for a volatile biotech company. To make informed trading decisions, we must compare current volatility against its own historical baseline using 4 rank. 4 rank, or IVR, normalizes implied volatility on a scale from 0 to 100 based on the last 52 weeks of data. By subtracting the 52-week low from the current 4 and dividing that by the total yearly range, we determine exactly where current pricing stands relative to the past year's extremes. It is crucial to interpret this percentage correctly, and 4 rank of 80 does not mean volatility is 80%, but rather that the current 4 is higher than 80% of the range defined by the last year. Conversely, a rank of 0 indicates implied volatility is at its absolute 52-week floor. This creates a standardized gauge to identify if options are historically expensive or cheap. This metric acts as your compass for strategy selection as we approach Phase 5 of this course. When 4 rank is high, premiums are inflated due to fear or uncertainty, favoring net selling strategies like credit spreads or Iron Condors to capture mean reversion. When 4 rank is low, premiums are cheap, favoring net buying strategies like long straddles or calendars. However, a word of caution: extremely high 4 rank often precedes a binary event like earnings or signals genuine market distress. Do not trade the number blindly. You must ensure the elevated premium justifies the specific risk you are taking. Next, we will distinguish 4 rank from 4 percentile.